U.S. student loans are a significant part of the financial landscape for millions of American students and graduates. These loans help students pay for their education but also create long-term financial obligations. In accounting, the way student loans are handled plays an important role in how both borrowers and lenders track and report the debt. Understanding the accounting principles involved in student loans can provide clarity on how these loans are managed, reported, and structured in financial records. This video explores the top 10 ways U.S. student loans are handled in accounting. 1. Classifying student loans as liabilities. In accounting, student loans are classified as liabilities on the borrower's balance sheet. This is because they represent money owed by the borrower to the lender. Depending on the stage of the loan, it can either be a current liability, due within 1 year, or a non-current liability, due after 1 year. The classification helps to determine how the debt impacts the borrower's financial position and cash flow over time. 2. Recording interest on student loans. Interest on student loans is typically accrued over the life of the loan and recorded as an expense for the borrower. For federal student loans, the interest rate is fixed or tied to inflation-based indices, and it is important to track interest payments as they accumulate over time. Interest payments are generally recorded in the period they are incurred, ensuring the accurate financial reporting of the borrower's obligations. 3. Capitalizing interest during the deferment period. For some student loans, such as federal loans, interest may be capitalized, added to the principal balance, during periods of deferment or forbearance. During these periods, the borrower does not make payments, and the interest that accrues is added to the principal loan balance, increasing the total amount owed. This capitalization must be tracked in accounting records to ensure that the loan balance is accurately reported in financial statements. 4. Handling loan forgiveness programs. Certain student loans may be eligible for forgiveness programs, such as Public Service Loan Forgiveness, PSLF, where borrowers can have their remaining loan balance forgiven after making a set number of qualifying payments. Accounting for loan forgiveness involves monitoring and tracking the borrower's progress toward forgiveness, as well as determining whether forgiveness should be recorded as income or treated as a reduction in liabilities. 5. Recording payments made on student loans. As student loan payments are made, they need to be recorded in the accounting system. Payments reduce the loan balance and are typically applied to both principal and interest. The portion that goes toward interest is recorded as an expense, while the portion that goes toward the principal reduces the outstanding liability. Properly allocating payments ensures that the borrower's financial records reflect accurate loan balances. 6. Handling consolidation of student loans. In some cases, borrowers may consolidate multiple student loans into one loan to simplify repayment. From an accounting perspective, loan consolidation involves adding together the balances of multiple loans and creating a new, single loan with new terms and a single interest rate. The consolidation is recorded by paying off the original loans and creating a new liability on the borrower's balance sheet for the consolidated amount. 7. Managing loan defaults and charge-offs. If a borrower defaults on their student loans, the lender may decide to charge off the debt, meaning they deem it unlikely to be collected. From an accounting perspective, a charge-off means that the lender removes the loan from their assets and recognizes it as a loss. However, the borrower's liability remains until the loan is either repaid or discharged, such as in cases of bankruptcy or student loan forgiveness. 8. Reporting student loan interest deduction for tax purposes. Borrowers who pay interest on their student loans may be eligible for a tax deduction, allowing them to deduct up to a certain amount of interest paid on their student loans each year. From an accounting perspective, it is important to track the interest paid on student loans to ensure borrowers can claim the maximum tax deduction. This requires proper record-keeping of interest payments and a clear understanding of tax laws surrounding the student loan interest deduction. 9. Using accrual accounting for student loan expenses. For businesses or educational institutions providing student loans, accrual accounting is often used to record revenues and expenses when they are incurred, rather than when cash changes hands. This method helps ensure that the interest income from loans is recognized in the period it is earned, even if payment has not yet been made. Similarly, expenses related to providing student loans are recognized as they are incurred, providing a more accurate representation of financial performance. 10. Accounting for federal versus private student loans. There are important distinctions between how federal and private student loans are handled in accounting. Federal student loans are typically subject to government-set rules and interest rates, and the terms are more standardized. In contrast, private loans may have different terms and interest rates, often based on the borrower's creditworthiness. From an accounting standpoint, it is crucial to differentiate between these types of loans because they can have different reporting and servicing requirements. Student loans play a crucial role in financing higher education, but their accounting treatment is complex and varies depending on the nature of the loan and the borrower's situation. Whether it's managing interest payments, handling deferments, or accounting for loan forgiveness, understanding the intricacies of student loan accounting is essential for borrowers and financial professionals alike. Properly managing these loans ensures accurate financial reporting and helps both borrowers and lenders maintain a clear picture of their financial standing. By keeping track of how student loans are classified, recorded, and reported, individuals and businesses can make informed financial decisions and stay compliant with relevant tax and accounting standards.